Hello, everyone. Roxanne Langley, your money coach located in Houston, Texas, here today. Welcome to this episode where we talk about purchasing a house. Now, my goal with each of my videos is to help you with straightforward, easy to understand information when it comes to your money. Whether it's debt relief that you're looking for, you want to learn about your credit, save for an emergency or for a future goal. Those are just some things, to name a few, that I can walk through with you. I provide the framework, tools, resources, and confidence so that you stop struggling with debt and with your money to live the life you deserve and with confidence. So let's get started with this week's episode. It is called Credit Score. Now, must I have an 800 or better to buy a house? You want to buy a house, and perhaps your credit isn't all that good, So it's, what should I do? The American dream for so many is, when you're ready to buy your first home, it's exciting. For years, you've worked hard, you've saved, and perhaps you've even started a family. The road to home ownership can be bumpy, it can be exciting, it can be very confusing at times, and stressful and overwhelming. But all in all, it's what, for the most part, it's what most people, they want to own their home, and that's huge. So I know when I purchased my first home, I had absolutely no idea the process that it entailed. You know, I I would wake up in the morning with checklist going off in my head, totally overwhelmed, and not even sure if I was going to be able to pull it off, mostly because of all the paperwork that they used to ask for you. Um, I mean, boxes of paperwork that they would want. Now it's much more streamlined, and it is easier. It's a lot easier to compile and upload and download documents now than it was several years ago. But regardless, being prepared, at least for part of this, when you do decide to purchase a home, it's so beneficial. So whether you're buying your first home or your 10th one, the process changes over the years. And so this will help us get started. So I always say you want to get mortgage ready. Now, what does that mean? There are three primary keys to convey that you have mortgage readiness, that you are mortgage ready to a financial institution. First of all lenders will review your credit history and look at your credit score from all three of the major credit bureaus, and typically they will go with the middle rating. This is known as what's called tri-merge. It's a good idea, and I always recommend, if you're thinking about buying a house, to go in and pull all three of those credit reports ahead of time. This way you are much better prepared, and if by chance something needs correcting, you can catch it early. Second, they analyze your capacity to repay the loan by looking at what's called your debt to income ratio. So what you want to do is aim for your mortgage payment, which will be a combined amount that will include your principal, interest, your property taxes, and your homeowner's insurance combined. to be no more than 25% of your income. If you've ever heard the term someone is house poor, that means that pretty much the bulk of their income is paying for their house. So that could be, they may bring home $4,000 a month, and if they have a $2,000 a month mortgage payment, that's 50% of their income. That's what you mean. That's what it means by being house poor. So try to keep that at 20, no more than 25%. Third, there is a review of the collateral value, which is the house that you're buying, to determine what it's worth. And this is done through your appraisal. If you are getting a loan, then it is required to have an appraisal of this, so that the loan originator knows what the property is worth. Now, each financial institution sets its own criteria for qualified credit history and scores, debt ratios, collateral values that they look for. So shop around with a few lenders before you find, the one that you want to find, one that's going to work with you. Now, also, just because one lender states, for instance, we will do your loan at 3.40%, that does not mean that it's 3.40% with every lender out there. So it does pay to shop, ask for a breakdown of all their fees along with the current interest rate. And you can have a little bit of negotiation in there depending on what your credit report and your credit score is. There is some wiggle room in there. So just because they quote a particular amount, if they say 3.40%, and let's say you've spoken with another institution and they quoted 3.25%, mention it, because they may come down. Now, there are options for you if you either have a very low credit score or a low credit history, meaning that you don't have much to show for it, or if you have no credit at all. If you don't have good credit, don't give up hope. It may just be that you'll be required to have some additional funding. You may need an alternative form of credit, or you may have to just generate a little more paperwork. For instance, a larger down payment. A down payment reduces the risk for the lender. So you have more skin in the game, so to speak. They have a buffer. Try to have at least 20% for your down payment. Twofold. It does show that you have, more skin in the game, but it also can save you money on private mortgage insurance, which is commonly referred to as PMI. That will actually be waived. And sometimes that can be $40, $50, $80, even $100 a month. Cash reserves, other than your down payment, if you have ample cash reserves on hand, let's say that you have 20% down, plus you have an additional $10,000 setting over in your emergency fund. This shows the lender you're stable. It also shows the lender that, for instance, if the water heater suddenly explodes, you aren't going to be scrambling, and you have money to make necessary repairs. And they actually look at those types of things. If you are coming out of a rental and maybe you're buying for the first time, or you're just, for whatever reason, you're buying again, maybe on your own, your rent history is important. So you may be asked, and it depends exactly how many months that they'll ask for, but be able to verify that you've paid your rent on time consistently for at least 12 months. Some lenders may ask for 24 months. If there is no credit, let's say that you have no credit or an extremely low score, consider the option of what's called manual underwriting. I know several clients, and I've had several, even more, fellow money coaches. They go this route with great success. It does require more paperwork for you to submit, and typically it may take a couple of weeks longer for the processing, but it's totally doable. So, I wish you the best of luck with home ownership and pursuing that, going down that path. Whenever you are, if you're ready to sit down and look at whether home ownership is good for you in the near future, can you swing it? What would it look like, with all the homeowners insurance and the taxes and all? Reach out to me. I would love to chat with you about it. We can look at your numbers together and create a plan so that that home becomes a blessing and a long-term blessing. So thank you so much for tuning in. If you would do me a huge favor and like and or share this episode with others that you think might find it interesting. It really helps as I'm trying to grow my business and become more visible. Again, if you have questions or comments, please reach out to me. You can drop comments below, or you can contact me directly. My website is roxannefinancialcoach.com. My email address is also roxannefinancialcoach@gmail.com. Come in, let me hear from you. I do offer a absolutely no cost consultation about your money challenges. I would love to learn more about what is keeping you stressed out or what your future goals are, and let's talk. So I thank you again for tuning in, and I hope you have a great, great day.